if you're able to look at this thing as we are, this is it. I look at reducing our energy consumption. I refer to as doing the work. So if you're looking at us from a GRESB performance, my goal is to be in the 90s.
Yep.
Well, my goal is to hit my goal for 2030 of lowering my carbon emissions, of which we are well under our way there. But I still look at this as a making money. I am not, as I said, typical ESG person. I'm an asset manager. I'm a deal guy. I'm a real estate guy. I look at everything from an ROI standpoint.
Hello, welcome to another episode of the Future of Commercial Real Estate Sustainability. Today, I'm speaking with David Natt, Senior Vice President, Asset Management and Sustainability at Avanath Capital Management. David, thank you so much for joining me here today.
Happy to be here.
Talk to me about the big trends you're seeing today in ESG and sustainability in both multifamily and affordable housing.
Great question. I think the going trend is like everyone is trying to fall in line with the standards that are set out by the 2015 Paris Environmental Accord. Specifically, the standards that are set is to reduce our carbon emissions by 50% by the year 2030 and be carbon neutral all the way out to 2050 and somewhere between then. And so I think what's happening with us is that we are a private equity company. So a lot of our decision making is not only being made internally by ourselves and owners of our company, but as well as our investor base. And a lot of our investor base is coming from Western Europe. And as well as, since we specialize in affordability, we also attract a lot of investors that are in the social impact space. So combined between the Western Europeans, as well as the social impact investors, they're holding us to a certain standard. And that's one of the reasons why, it wasn't the only reason why, but it's one of the reasons why we have really built and executed a very robust, in my opinion, a very successful ESG platform that we are quite proud of.
Can you talk to us at a high level about what Avanath's ESG report looks like today?
Well, I think the good way of answering that question is just discuss our GRESB score. So everyone in the industry, I won't say everyone, but a lot of the operators and investors in the industry, not only for multifamily, but for commercial office, retail, industrial, maybe even hotels, et cetera, they're all using this scoring methodology. It's called the GRESB, Global Real Estate Sustainability Benchmark, I believe. I think that's what the acronym is for. Think of that as a report card. So it's basically, you're filling out a very detailed survey about what you're doing, as well as it also has to be validated. Everything has to be documented. So it's giving you a score. And so when we first started out in 2020, and our first filing, I think, was 2021, 2022, we had a score of in the 40s. And so, which is basically, I would say probably that's kind of typical for an earlier filing. We've taken, in a very short period of time, 4 years, we've gone from the 40s. Now we are in the very, very high 80s.
Wow.
And so also another scoring methodology they have is stars.
Yep.
So associated with the 40s, we got 1 star. Now that we are in like the mid 80s to the upper 80s, 85 to 89 to be exact, our scores for our 3 funds are in the 4s, and one of them is in a 5. So we've done a really, really great job in getting our scores up. And again, that is a reflection of our commitment to ESG, our policies and procedures, our data collection, because this whole thing is all about data. If you don't have the data, you don't have anything, in my opinion. And as well as we're being scored on what I refer to as doing the work at the property, reducing our carbon emissions. So if you're reducing your carbon emissions, you're reducing your electric consumption. You're also reducing your natural gas consumption, and also throw in, even though it's not carbon related, but we are being measured on water reduction or water efficiency.
Yep.
So in a very, very short period of time, we have done a great job, and we are well ahead of our original plan for ESG when we kind of embarked on this in basically 2020, 2021.
For a business owner who might be back where you were in 2020 and 2021, how can they build a business case internally for investments in sustainable improvements, whether they're in multifamily or any sort of specter of CRE?
You need to understand first, what is your goal and what are your goals? and what's driving those goals. And so I can't speak for other operators. I could talk about for us. As I mentioned before, for us, a lot of our institutional European investors, as well as some of our domestic investors, are asking this for us. Also, within the space, you also have to think about investor return. So ESG is just not a black hole. And I think some of the people who are approaching it that way, I'm not sure how sustainable it is, financially sustainable, not the other sustainable. I approach it, or we approach it from a financial sustainability standpoint, because our investors, who are still a private equity for-profit organization, so we still need to provide a distribution to our investors on a quarterly basis. So when we're looking at implementing some sort of a change to our property from an ESG standpoint, making an investment, we actually have it boiled down to what is my return on investment? What's my incremental ROI on there? So going back to your question in a very long-winded way, is that what I would offer anyone who wants to do this, think about what is your goal, then as well as you want to put your best foot forward. And I would really highly suggest you think about hiring an ESG consulting company if you don't have the expertise in-house. Additionally, what you're going to still need to have is the data capability. So you're going to need to figure out, it's like, who's measuring your data? How do you measure it? Are you using Yardi, using RealPage? How's the data coming about? Because if you don't have the data in place, I think you're really kidding yourself, because you're not going to be able to measure the consumption. You're not going to be able to really file the GRESB survey accurately. But I think the first thing else also I would be thinking about is hiring an ESG consultant. And that's something we did early on, and that was the best decision that we've ever made, because we did not have the expertise in-house. I come from the business side. My background is on the deal side. My background is development. My background is asset management. This kind of fell into my lap, where I kind of took it to another level. And I had some experience in my prior company because I was exposed to a lot of ESG, but I took that exposure as a means to basically make my portfolio more energy efficient, which to me, that was all about an ROI, or improving my NOI across my entire portfolio.
For a listener who might be surprised to hear that there's real financial ROI on these sustainable and ESG investments, can you share like a real world story where you saw maybe unexpected returns in your portfolio, and what sustainable improvement drove that?
Oh, 100%. And I'm going to basically talk about a couple products that I love, and I'm going to be shameless in promoting them. I'm not sure if neurotic is the right word, but I focus in on water. And a lot of our properties are located in California or in other areas that are impacted by the drought. So I look at how much water do you consume, and I look at the finite areas of it. So you have your commode or your toilet, you have your shower head, you have your sink. You would have, if it's a one-bedroom apartment, you would have a sink in the kitchen, a sink in the bathroom, and then you have the tub, shower, then the bath toilet. You can get a device called the Aquamizer, and the Aquamizer will take the gallon flush. With most toilets are typically around 1.5 gallons in this day and age, and went a little bit higher. Some of the older ones can go all the way up to 3 gallons. You can take the Aquamizer. That will actually reduce your flush from about 1.5 gallons basically down to less than 1 gallon, maybe like 0.7 of the flush, as well as because of the way it's designed. The Aquamizer itself will prevent running toilets. So if you have an old flapper or whatever, and you hear the water running, that uses up a ton of water. So from an ROI standpoint, I'm getting roughly about 30% on my money. My payback period is probably less than 3 years. Actually, it's less than 2 years, what am I saying, on the Aquamizer, that itself. Another thing that I'm really proud of is with what we're doing from an electrification standpoint. We are looking to get rid of the hot water heaters at a number of our properties. So we swapped out the inefficient hot water heaters, and as well as the HVAC units with higher SEER level HVACs, and as well as electric heat pumps. Mm-hmm. So if we look at that, because these properties are the garden style, so our use for natural gas is fairly low because we don't have the giant boilers and whatever. The incremental ROI on that gas, basically converting the gas to heat pumps, it was low. It's roughly around a 3% ROI. So in our case, part of the challenge that we have is that we're affordable property. So we don't have, a ton of capital to make these investments. So we rely very heavily on rebate dollars from either at the local, at the state, or even at the federal level to help subsidize this. So in this case, with these properties I'm talking about in Southern California, that we swapped out these water heaters for heat pumps, we were able to get some sort of grants to basically cover, I would say maybe like 75 to 80% of our total cost, maybe a little bit higher. So that 3%, that 2 or 3%, that equated to basically 15% on our money. And additionally, what we're doing is to help subsidize the additional electric load. We have a program in place to install solar on top of these apartment buildings. Not only these two properties I'm talking about, in California, we have an agreement in place to install solar on 18 properties. And that, again, is not going to cost us any money. And so we have arrangements. We're working with another company called Sunrun, which is I think it's the largest solar REIT, where they're going to come in, and we're working with another program in California called SOMA. With the SOMA money, which is solar on multifamily affordable housing in California, it's funded through the various different utility companies in California. They help provide us with the equity. Sunrun's putting up the rest of the money. We enter into a long-term lease. The property, get the benefit, and as part of SOMA, a disproportion of the electricity, so call it about north of 55% of that electricity, will go directly to the residents that live at our property. So if you, Mr. Jones, who lives in Unit 1A, if your electric bill is $100 and throwing numbers out, you're going to basically get maybe like a 50%, or we'll get a $50 direct credit. That's what we believe we'll get. So that's freeing up some like $50 a month. That's basically, that's some real disposable income for folks that in the affordable space, that's material.
Yeah.
We are going to be looking to roll this thing out across 18 of our properties in California. We're looking at to do some stuff in Washington State and elsewhere in the country, utilizing funds at the federal level from the Inflation Reduction Act, or Solar for Now. And so that's basically going to be our mapping for our game plan hopefully for 2025 and 2026. So just to going back to where this all comes in from a strategic standpoint, I mentioned earlier on, part of our goal when we started out was to adopt the standards set out by the 2015 Paris Environmental Accord. Part of that is to reduce our carbon emissions by 50% by the year 2030. How am I going to do that? Part of that's through solar. Those 18 properties, that equates to basically on an annual basis, about 15 to 18% of my current total emissions at my property.
Wow.
15 to 18%.
Incredible.
So I'm well on my way. So going back to my earlier point about data, if you don't have the data, you can't figure any of this stuff out. So anyone who really wants to start in this, have a really good, effective ESG, first building block is data. And then have a really good ESG consultant, as we have, and we work very closely with a company called Retech Advisors. And we've hired them. I used to work with a former Retech earlier on in my prior company, and we have a wonderful relationship. And they've been advising us, and actually I learned the business from their expertise.
Yeah. And I appreciate you mentioning all those things you did, David, because things like the IRA and the tax credits that it enables, and solar for all, and solar for multifamily affordable housing, SOMA, all these programs, we're trying to get people educated on this because really it's a resource to them. It lowers your cost of electricity. It helps you with your ESG. To your point, I mean, the payback period is really short, and it's a huge reduction in your carbon.
If you're able to look at this thing as we are, this is it. I look at reducing our energy consumption. I refer to it as doing the work. So if you're looking at us from a GRESB performance, my goal is to be in the 90s. Well, my goal is to hit my goal for 2030 of lowering my carbon emissions, of which we are well under our way there. But I still look at this as making money. I am not, as I said, as typical ESG person. I'm an asset manager. I'm a deal guy. I'm a real estate guy. And I look at everything from an ROI standpoint. If I'm throwing money away, one is that I'm not going to be able to get buy-in from either my colleagues or the partners or the owners of my company. I have to demonstrate how I'm going to do this and how do we make money and what is the true benefit, not only to our investors, but more importantly, to the residents that live our property. That is that is a fundamental part of our ESG. And then we can talk about our social side of our business as well, if you want, but just talking about the sustainability, I look at everything on an incremental basis where we have to make money.
Speaking of investors, how are institutional investors reshaping expectations around ESG in affordable housing, multifamily, and other area sectors?
They're driving it. Certain ones are driving it. So a couple of years ago, we were in the 60s. And we thought we were great because in a very short time, we went from a 40 up to a 60. And mind you, we just started this then, 2021, 2022. That's when we really started to get on the strategy. And they told us, you have to be in the 80s. And we're saying, what? You have to be in the 80s. I said, there is no way we can, because one is that the GRESB, how great it is, it also has its shortfalls. And I know they are aware of this and they are looking to change their scoring methodology or adapt it. And they're going through a lot of changes right now. But as an affordable player, there is a bias against us. One is that the GRESB was originally designed for commercial office and or retail. And with multifamily, particularly with affordable, most of our properties are older in nature. So if the GRESB, if caters to companies for newer product, if you have elite certification, et cetera, you get some additional points. I think we have maybe like 2 properties, maybe 3, possibly 4 properties on our total portfolio that has that's LEED certified. So we had to come up with alternative ways where we could substitute the scoring there. So that's a real problem that we face with the GRESB methodology. So when we went from people asking us, hey, you got to go from 68, we said, whoa. It's a little bit harder for us here. And as well as I think it's a little bit unfair.
Mm-hmm.
And gave them the reasons why. And they said, we understand, we're complete agreement. We're not going to debate or argue against you. But our sub-portfolio managers, they're telling us, if you don't hit a certain score or if you don't have these stars, we won't consider you or we will pull our money out of your funds.
Wow.
So for us, that was a real sobering moment where we doubled down on our efforts. I doubled down. Before I had like 2 jobs. At that point, they asked me, we want you to strictly focus on ESG and further building out our platform with the goal to go from the 60s to the 80. And we did it. I mean, we were pleasantly surprised. And I mean, we put a lot of work into it, but we satisfied. And then for the next year, this past year, we scored even higher. So to answer your question, our investors are driving this as well as obviously myself. I'm pushing the envelope to the idea where I want to separate ourselves from the rest of the industry, because when Avanath set out with this goal of creating an ESG platform, we had certain goals in mind. One of it was to be a leader within the space, even though a lot of it is sort of like lip service. You can say that, but we want to be a leader not only in the multifamily place, but especially in the affordable space. This is something that is part of our ethos. It's our mission statement is lifestyles within reach for our residents. So we want to advocate not only basically raise more money within the space for us, but for us to invest and acquire more multifamily and for us to acquire, for example, market rate and convert to affordable, which is what we do with a lot of our properties. But there's a huge philosophy behind this, where again, we could separate ourselves from the rest of the industry, even within the ESG space now, where people are calling us up and you're saying, how are you doing this? How are you able to put solar on 15 or 18 properties? Which, by the way, once we achieve this, which we're on our way to do so, this will be the largest dedicated, or I was told, this will be the largest dedicated portfolio of solar in the country.
Wow. That's amazing.
Yeah. So, we're on our way. And also to throw the other mix, I'm tooting my horn here. We're also, as a leader within the industry, we were the first company to get approval by Fannie Mae to install solar.
Wow.
We were first.
Incredible.
So by doing that, Fannie Mae kind of designed a lot of their policies about putting solar on top of the roof around us. So that's something else we're very proud of. And that just happened earlier in 2024.
You mentioned tenants. What are you seeing as far as tenant demand or appetite for these sustainability related upgrades?
Not so much. So what we're trying to do is because of their tenants, we can't tell them what to do or how they change their lifestyle. What we're trying to do is kind of teach them about ideas of how they could save money or how they could do the right thing from a sustainability standpoint, but as well as with the ideas, hey, you can save money by doing this. So we're encouraging them to, one, if you position your furniture in your apartment a certain way, you may be able to lower your need to either or increasing your AC or your heat or whatever. If you pull for example, your refrigerator away from the wall and you have more space for circulation, that itself will lower your electricity bill. So, and as well as with what we're doing from a water consumption standpoint, slowly we're installing a lot of low flow shower heads as well as aerators. So that itself, even though that bill is us, it goes for us, but obviously it's for the greater good. But for the residents themselves, we're encouraging them with the benefits of recycling and what's involved with recycling. We also deal a lot with organic trash itself. So we're encouraging them to take advantage of that. So there's different means. And also this is all about educating where they could, again, reduce their own energy consumption, their own electric bills.
The next lead in, how has your approach to property repositioning evolved with growing ESG demands?
Great question. As part of our acquisition process, we not only look at each property for climate risk and transition risk, but as well as we do a desktop review. So we kind of assess where are some of the areas and the improvements that the property can make from an ESG standpoint. So we'll look at properties, say, okay, is there an opportunity to install LED lights to lower the electric bill, or look at the water situation? Do we have a pool? Are they variable speed pumps in the pool? Can we swap that out? So working with our ESG consultant, RETEC, we look at the property. They do sort of like a desktop review of some of the larger and or more complicated projects that we sometimes purchase, like in New York City or whatever. We'll do like a complete site walk with them. In this way, they're able to tabulate different ways of where we can make the property more energy efficient. As part of that is part of the overall positioning of the property.
What's changing in the ways you measure the success of your sustainability initiatives?
That's a great question. I'm looking at it for two ways. I look at everything from an incremental ROI to see how this adds to individually. I look at on an individual project. I also look at the overall utility spend, and also look at it from a complete portfolio basis. So I looked at the entire portfolio. We have some 115, 120 some properties. And there I basically did a mean variance analysis for utilities, for all the utility spend. That would be for electric separately, natural gas, and water. This way I'm able to figure out what my mean line is and figure out which properties are above and or below. What I wanted to be able to do is to identify what I call the energy pigs, the properties that are consuming above the mean, and figure out what's going on there and start tackling those properties. So that's really what I'm kind of focusing on. How do I reduce the total spend on the utility standpoint to basically lower expenses, increase NOI, increase our overall profitability in our portfolio for our investors. So you go back to what I was preaching earlier about looking at ESG from an ROI standpoint, we're doing it. And by the way, by reducing my gas and electric spend or consumption, that correlates 100% with my carbon emissions. Tying back to where I become passionate. Some people accuse me of being neurotic, but how do I look at my goal of 2030? How am I going to get there? Because we're just at Avanath, we just don't put stuff out there. If we're going to put something out there, we need to document that we're doing it, getting the results, or how are we going to get there? And that's something that we do for our investors and for our own credibility within the industry.
How do you go about structuring sustainability improvements to make sure you're maintaining long-term affordability at these properties?
To maintain long-term affordability, that's set by the regulation agreements that we have. So you can't mess around with that. I mean, so if it's affordable, it's affordable.
Mm-hmm.
So ESG or anything else, we can't do that. We're actually going the other way. We're actually taking market rate units. So when we buy a property and we can set rents or whatever it is based on the market, we are saying, no, we're going to put in a LORA or some sort of a restriction on the affordability with that particular unit. And we're going to put that basically on title. So we are actually doing the opposite. We're actually increasing the number of affordable units within various different communities.
Which sustainability improvements have you seen deliver the best ROI, even during these last few years with all the economic uncertainty?
The best ROI is water. To be honest with you, the best is literally, it's the shower head. So it's a little tricky with the shower head because if you put it low flows, people would want to tend to take longer showers. They actually will replace it. And they should just say, I'll get another one, put my own in there. But for the most part, it's a fairly inexpensive and you get a lot of return on your money. Also, LED lights, you're getting around a 30% ROI on LED lights.
Wow.
And also, one thing that we're really focusing on right now is putting in motion detection switches. So again, all of our properties, a lot of them are built in the 90s, some in the 80s, some even before then. We have some properties that were built in the 1920s in Boston. But what we want to be able to do is, some of these lights are kept on all the time. Bathroom lights in the common areas. Sometimes those lights never go out. So, what we want to do, we want to be conscious of security. I mean, security in our properties are the most important thing. We want to provide the most secure places for our residents to live and to make, for the safety of our residents. But yeah, we're looking at that's really low hanging fruit for us.
Looking ahead 5 to 10 years, what sustainable strategies do you foresee Avanath pursuing outside of what you're doing today?
I think it's just going to be a continuation. And so it's going to be the continuation of installing solar and electrification. And I think the technology will change. I think the solar technology will improve, or maybe there may be another change in the industry, something I'm not completely aware of. But right now, if you're asking me what's my vision, is to take with what I'm doing in California and do that in Texas, do that in Colorado, and bring it out east.
This show is called The Future of CRE Sustainability. What do you hope the marketplace overall will do? If we look to the future, what are you hoping people will really get into when it comes to sustainability and ESG as a whole?
I think, and I often think about this now, especially given the fact of there's been a change of an administration, and I'm not going to comment on politics, but I do hope that with the industry will continue, because obviously I believe in global warming. I'm tired of having the conversation with my kids saying, when I was your age, we used to go sledding on the streets and the snow used to be around for weeks at a time where we could continue going sledding or play ice hockey on the ponds. That doesn't exist anymore, sadly. But I'm a firm believer that we need to improve our society, and particularly from a global warming standpoint. And as I get older, I get a little bit more philosophical. And I think about this more often. It's like, before I never really thought much about it. It's like, what am I turning this thing over to my kids? Or if I ever have grandkids, which is important. And so I think right now, I'm not sure if the public sector will lead this, but I really hope is that it's the private sector. And hopefully the investors are saying, I come from an institutional investor world. I've always worked on the institutional side of this business from day one earlier on my career. So I really believe is that if the institutional capital is saying, hey, if you want our money, you got to do this. You have to provide the data supporting that you're doing this. So I think by having companies like Avanath Capital who really have a real mandate aside from the capital, but as yet, if you're being pushed by your capital base, I hopefully think that's where the industry will go. I'm hopeful that, as well as I hope that everyone will still be a firm believer in this, and actually everyone will take a true participation in this responsibility. We can't do it on our own. And I'm a firm believer. It's like, there is no secret sauce in ESG. My strategy, if I'm going to be having any proprietary strategy of what we're doing, and not telling everyone, what's the point? We're not that big. I'm not as big as my old company that I worked for, which is a very large institution. They can help push the market. We're a little player, but I'm coming up with different ideas and share my ideas, and some things work, some may not work. But the idea is collaboration versus competition. And you can't have that in the ESG space.
It's going to take all of us pitching in to save the planet, I think is what you're saying. And I guess if you're one of those people who that's not enough, to what you said earlier, there is real financial incentive and real ROI to be had with ESG investment.
And the whole point is, like, with ESG, I boil it down to either from an asset management standpoint and portfolio management standpoint to drive your utilities down. From doing this mean and variance analysis, yes, I was able to identify these very certain outliers, but guess what? My mean, I can bring that down. I'm confident I can bring that down. So that's all bottom line.
Yep.
Bottom line, as well as also for the greater good.
David, this has been an incredible talk. I really appreciate you taking the time to meet with me today. If people want to learn more about you, the work you're doing, or more about Avanath, where should they go?
Feel free to contact me at David Natt. You can find me at my website, my company's website at avanath.com. But my email address is dnatt@avanath.com. Happy to speak to anyone. I can talk to you forever about the subject matter. Very passionate.
I can tell, and it's lovely to have you on. Thank you all for tuning in to another episode of the Future of CRE Sustainability. We'll see you next time. Thanks.
Thank you very much.